they're going to end up creating a foreclosure crisis that could happen very, very quickly. This is a major risk for the Canadian banking system, and it's a major risk for the housing market right now. Banking regulator OSFI is flagging the housing market as a risk to Canada's economy, and not only that, is considering beefing up the stress test even more because it was just so fantastic to begin with. So let's dig into that and more in today's video. So let's head over to CBC and see what's going on. Banking regulator OSFI flags housing market as risk for Canada's economy. Yeah, no shit, right? I mean, the housing market is a major risk for Canada's economy. I don't think that's any surprise for us here on the channel. But let's see what they're saying here, because it is really quite interesting how late to the party they are. Canada's bank regulator said it is preparing for strain in the housing market to potentially last throughout the year as it flags the sector as a growing concern. The Office of the Superintendent of Financial Institutions said Tuesday in its latest annual risk outlook that the housing market is its top source of worry, as high rates mean higher default probabilities. I mean, we're already seeing defaults rise. They're just not being called defaults. They're essentially shadow defaults. That's what I like to call them. But essentially, when you're seeing a lot of loan balances that are increasing, when you look at the bank's mortgage portfolios, that is essentially defaults. You know, they're just not calling it default. And it's kind of funny because even the banks are saying it's not sustainable. Even the OSFI has said it's not sustainable, yet nobody does fuck all about it. Nobody does anything about it. I don't get it. It's just absolutely insane. They'll just wait until the whole system implodes, which it will, because as soon as unemployment starts to rise, this whole thing just goes completely to pot. So let's continue on here and see what else they're saying. OSFI is preparing for the possibility, but not predicting, that the housing market will experience sustained weakness throughout 2023, said Superintendent Peter Routledge on a media conference call. I mean, I think that's kind of, you know, we're already seeing a sort of rebound in the housing market right now. So it's interesting that they're coming out and saying that. I mean, the market is getting more illiquid, yes, but you've also had a lot of sellers that are in denial, don't want to list right now, can't list because they can't get the prices that they want. So that is causing a lot of inventories to be really, really tight. And in this spring market, it's causing prices to rise. It's causing this kind of bull trap to come out and show its face, something that I've been talking about since last year, since way back during the spring and summer of last year. So anyway, let's see what else they're saying. Credit quality, however, so far looks quite strong and residential real estate remains sound. I do not even understand how they can have the audacity to say that when you think of what's going on in terms of mortgage balances increasing because of people with these fixed payment variable rate mortgages. And we've done many videos on this channel that have shown the dangers of that. And that could be the potential crisis that the yield curve is in fact warning about. So, you know, the fact that they're saying everything looks really good in the residential mortgage market is just absolutely insane. And I think we have to remember this, kind of bookmark this, because it's a moment that we may look back on and say, wow, just how asleep were the regulators at the wheel? And if the person who's making the next Big Short movie, The Big Short Canada, is watching this video, then please reach out to me and we could talk about it. So anyway, let's continue on here, see what else they're saying. What's interesting now is how benign conditions have remained. Underlying that is a very strong economy. Unemployment is still very low. And because of that, Canadians are servicing the higher cost of debt quite handily. No, they're not. We're seeing the distress occur once again with the loan balances increasing. That is showing major stress in the mortgage markets. It's just shadow defaults. It's just nobody is saying they're defaulting. They're just allowing them to stretch out the amortizations, negative amortizations, essentially. And that just means that the borrower isn't even paying the interest on the loan. They're not even meeting the interest obligations, let alone the actual principal obligations. So how does that tell you that everything is fine right now in the mortgage market? I mean, to me, that is flashing code red that everything is wrong within the mortgage market right now. And you have got the potential recipe for a banking crisis. And I say the potential recipe because all it takes is the laggiest of lagging indicators, which is unemployment, to start shooting up, which it will do because of the effect of the higher rates on corporations. They will have to cut back and lay people off, and that's already started, but it will just get worse and worse and worse as the lag effects become less and less and less of the rate hikes. So we're soon going to see that, and that is going to cause major problems because a lot of people are going to be so far underwater on their home purchase and on their mortgage that they're going to end up creating a foreclosure crisis that could happen very quickly. This is a major risk for the Canadian banking system, and it's a major risk for the housing market right now. And I think it's just insane how people are kind of asleep about this. They're kind of denying this. A lot of people actually think this is bullish for the housing market, which is just insane. And I think in the short term, it is bullish for the housing market because it's allowing people to stay in their homes. Like I said, once they eventually get into distress, which is likely, I mean, as they push out their amortization more, the probability of them losing their home is rising more and more and more. And as obviously they get more underwater on their house, we know from 2008, from the NBER report that was done in 2016, that when people go more underwater on their home purchase, they're way more likely to end up in foreclosure. So I think that's telling us what's going to happen here. But again, the regulators are just completely asleep at the wheel. The banks, they know what's going on, but they're just not doing anything about it because they don't care at this point. It's just kind of hilarious. I mean, to a certain degree, they are right when they say how benign conditions are right now. It's like the calm before the storm, essentially. That doesn't mean that you just kind of let things get more relaxed or you don't do anything about what's going on. And even they outline in this report, which I just find absolutely hilarious, they even talk about negative amortization. So to better prepare for future risks, the regulator is working through its review of B20 mortgage underwriting rules that include the stress test. Public consultations closed April 14th on the first phase, looking at debt servicing measures to control risks around high consumer debt levels, while further consultations are planned as part of the process that is expected to run most of the year. I mean, if you haven't realized already, the whole economies of places like Canada, the United States, the UK, many countries in Europe revolve around credit expansion, not credit contraction. So I'm always kind of a little bit skeptical when they're talking about, oh, you know, we're looking at the high consumer debt levels and we're like, oh, because when you really think about what's going on, the end goal is most of these central planners and authoritarians, they actually want debt levels to increase. Then you're easier to control, you're easier to manipulate. And we definitely saw that during 2020 and 2021, 100% in Canada, because people were controlled and manipulated into social credit scoring type systems without them even realizing it. And still, you know, I think all is forgotten about that, but that was only a couple of years ago. But anyway, let's carry on here. So the regulator is also taking a closer look at how banks are handling variable rate fixed payment mortgages, which should have never existed in the first place, which keeps monthly payments at the same even as interest rates rise by putting less and less of the payments towards the principal. The payments for some borrowers aren't even covering interest costs, so banks have been stretching out the amortization period, which they're able to do right now, again, because people are employed and because people aren't renewing right now. But as soon as those people get to come to renewal or they lose their job, it's just creating a future crisis. And I hope that you can see that and realize that, yes, it is can kicking to a certain extent, but it's almost guaranteeing a a future banking crisis, because this is always what you see in the demise of a bubble is people can't even service the interest for their debt. You know, one book I would encourage you to read is a book by Hilliard Macbeth. I'll link it in the description below because I think it explains this very, very well in that book by looking at past bubbles and past data. So anyway, let's continue on here and see what else they're saying. The payments for some borrowers aren't even covering interest costs, so the banks are stretching out the amortization periods. The specific mortgage product isn't an immediate concern, said Routledge. And again, I mean, that just shows how insane the OSFI really is, because how is it not of immediate concern to them when you have as many loans as we're seeing where loan balances are increasing with the banks, meaning that people aren't covering the interest or the principal on their loan, so their loan balance is just increasing. It's just an absolute disaster, and I find it absolutely hilarious how the regulators are asleep at the wheel like this. But it could become one in the next 2 or 3 years as the terms begin to reset and be repriced and borrowers feel a greater hit from higher rates. So he is talking about the future risk, but he's saying we're not going to do anything about that future risk right now. We're just going to leave it. We'll just wait until that future risk comes to fruition. I mean, this just goes to show how dumb these regulators really are and how asleep they really are. You know, a lot of people talk about how sound the Canadian financial system is. Does it make you feel better knowing that the banking regulator is this asleep when it comes to the housing market? Knowing that me and you are much more awake than even they are, and they're the ones who are controlling, making the decisions and the regulations for the banks? I mean, does that give you any faith at all in the banking system? Because it certainly doesn't to me. So anyway, let's see what else they're saying. The regulator is actively assessing the risk and looking into whether banks are putting enough capital aside for potential issues from borrowers with the product. And we know they're not. We've gone through this many times that banks are not they're putting token amounts away for loss provisions. And when you especially look at the amount of their loan book where the balances are increasing, essentially those borrowers are in distress and they are not putting nearly enough away to deal with that problem. Again, just creating future problems down the road, which we're going to see. So it's going to be interesting as this thing moves along. And then they're also talking about liquidity in commercial real estate, which is also of concern. Generally, we're seeing across all lending sectors, including commercial lending, a slowdown in credit growth, said Routledge. Anecdotally, I would characterize it as so far as a manageable, not extraordinary slowdown. The collapse of Silicon Valley Bank and Credit Suisse have also raised concerns that the banks will become more cautious on lending. But Routledge said that thus far, he's seen a deceleration in credit growth, not a decline, which you kind of expect anyways with rising rates. Commercial real estate is another source of risk as office values have plunged because of the shift to remote work. The regulator said it is conducting targeted monitoring and considering whether to develop specific guidelines for the sector. I mean, again, it's way too late for that. There are way too many derivative products. Brookfield looks like it's going to go bankrupt. That's a company that employs 200,000 people. Headquarters is in Toronto. Could that be the future Black Swan event that we're looking at? Who knows? But that is 10, 20 times bigger than Lehman. There are major problems and they're losing a lot of money. And like I said, it looks like from their earnings that they're going to go bankrupt if they continue at this pace, which is looking likely, and things are only getting worse in that sector. So what does that mean going forward? Other key areas of concern include the growth of private credit from providers like hedge funds and pensions, as lending in the space has boomed in the last decade with little to no prudential regulation. Digital innovation in finance through areas like cryptocurrency and artificial intelligence, climate change issues related both to physical risks and transition risks, cybersecurity, especially amid higher geopolitical tension, and third-party risks from banks relying on systems like cloud computing. And you know what they talk about there in terms of lending from hedge funds and pension funds, which have basically gone into things like commercial real estate. Why have they done that? Why have they done that? It's because rates have been so low. And who pushed the rates low? It was ultimately the government that forced the banks to have just this unbelievable monetary policy for the past decade, which has really just turned into an absolute disaster right now as we're seeing the wheels come off this. And it's not just in Canada, it's in many countries that we're seeing the wheels come off. Even countries like Australia and New Zealand, which are in similar situations with similar sized bubbles as measured by GDP. So it's really going to be interesting moving forward. We're going to have to see what goes on with this. But anyway, we'll continue to monitor it here at the channel. So anyway, if you've enjoyed this video, you might like that video there. You might also like this video there. I will see you in the next one. Take care of yourselves, guys. Bye-bye.